let's talk about those three moving parts. So Sprott, removing them from the equation, you've still got Equinox that you need to remove from the equation, and then you've Greenstone has come in for a larger slice of the pie. So first of all, why did you want to get rid of Sprott? Why not refinance with Sprott?
We went through a number of issues, and ultimately lenders such as Sprott are not the cheapest. And we've had a very good relationship with them. But I think we will go back to them when we come back to looking for financing of Coringa. I'm sure you've got some questions later on that you'll ask me about that particular subject as well. But the essence here was that we have to go back even further. We go back into sort of the third, fourth quarter of 2019. At that particular point, we had the debt with Equinox that needed to be settled. We were looking around at sources of finance. It was a difficult equity market. And ultimately, the decision to go with Greenstone and to put in place the convertible loan was to give us a little bit more flexibility in terms of how much money we'd need going forward, but to make sure that we had funds available to be able to meet that particular debt with Equinox, which at the time was going to fall due on the 31st of December. Now, we pushed that back to the 31st of March. And then subsequently, we've been able to renegotiate that very well into a series of stage payments because of the pandemic. And that's given us a great deal more flexibility, which actually should be beneficial ultimately to shareholders. So I think the decision to want to get rid of or pay down the Sprott debt rather than refinance that is because we couldn't see Sprott, given where our cash flows were going to be, wanting to extend a debt facility to us that was large enough to take care of that potential balloon payment to Equinox. Greenstone were able to step into there, a friendly shareholder that's providing financial support into the company with a little bit more flexibility than we were likely to get.
I always think it's quite an interesting discussion. When you owe people money, you can either be in a position of weakness or a position of strength, but in a way the market worked in your favor with your negotiations with Equinox, I think, it seems to me.
It did, and circumstances helped. We were clearly coming up to a point at the end of March where we needed to do something. We thought that we'd have the facility in place. Of course, then coronavirus hit us. But I think circumstances then have, that did work in our favour in some ways, because Equinox looked at the situation, were sympathetic to where we were as a small junior producer, and gave us the leeway to be able to look at a stage payment basis that wasn't, rather than putting the company into a difficult situation. So we were very grateful for that, and we've been very grateful for Greenstone to continue to support it as well, because we couldn't again fulfill all of the needs and requirements. And ultimately, although they're a shareholder, they're a business. They've got their own thresholds to meet with their investor groups as well. And I'm sure that the convertible doesn't necessarily meet all of those thresholds, but that's a sort of gesture of their support and long-standing support for the company.
I think, like I say, timing and luck come into this a lot, and Equinox also have been going on quite a rally. I think it's also helped you that they've done exceptionally well at building out their business. But just on Greenstone though, because obviously they're very well-known investment group with very specific mining skills, and sort of they're very clear about the sorts of companies that they will invest in. I mean, that's a real endorsement, I think, to the market that you've got something going on there. But they've also come in for a pretty big stake now. So what are their demands of you as an organization in terms of performance?